It means we bring on the legendary investor, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Nice to see you as well. I sort of rambled in my head. I'm like, investor, entrepreneur. I should have said both because you're a great investor and entrepreneur. So thank you for being here.
All of it. Yep.
There you go. Hey, one of the things that you brought to the channel, I think it was 6 weeks ago, it actually might have been 8, was this concept of the great deleverage. First time I'd ever heard it. We've talked about it a couple of times, but this morning is proof positive that you were right. You are right. So let's talk about what it is first, just in case others have missed it, and then we'll get into some questions. So what is the great deleverage?
So this is an unwinding of all the liquidity in the system out there. There's been over $1 trillion pumped into the system since March of 2020. And if you look at all assets across the board, they're parabolic from March 2020 on. So at some point that has to unwind, or what happens is, the Fed's already lost credibility around the world. Mm-hmm. So, they've made a huge policy mistake. They came out with too much, too long. They didn't pull back quick enough. They ignored and denied inflation. And what that did to investors around the world is basically sent the signal that the Fed is clueless. They don't know what's going on. They, are lost in reality. So what that ultimately does is it affects people's confidence in the dollar. So if people lose, faith in the Fed, they're losing faith in the dollar. So the Fed has realized too late, once again, that, if they don't do something and do something quick, that, people will lose confidence and faith in the dollar. And then that creates, an inability of the United States to borrow money and to issue debt, globally. So they had a real dilemma that they're facing. Number one, do we tank the markets to gain credibility back and to gain strength in the dollar? Or, do we keep going as we're going, keep pumping liquidity in the market and, keep devaluing, not the dollar in itself, but faith in the dollar. That's what's really been devalued. So that's what this is all about. And, I've always said 2 things. Number one, you got to know the top. It's always better to know the top than the bottom. And, we've been talking about this top here for the last 6 months, and it's not an instant thing. So when I say top, it's not going to happen overnight and then bam, it's downhill. Yeah. We've seen, as the Fed has come out and raised the flag here or there and signaled, we're going to move. Nobody really believed they were going to do anything anytime soon because they were still denying inflation. Then they came out and said, we're going to move. But they said, we're going to move slowly. We're going to pull back, taper first, then we're going to raise rates. Then the other day, Friday last week, they said, wait a minute, we're going to, reduce purchases, and we're going to raise rates at the same time. And we're going to raise rates more often than what we said we were going to do. So now, boom, again, another policy mistake. Yeah. So they've gone from the extreme of too much too fast to the extreme of too much too fast of the unwinding. So it's really interesting, what's going on, and we'll just have to see what the effects are. But it's not so bad right now. Markets are only down 3 to 5%. Between the Dow and the S&P, and then Nasdaq's down about 8% now in the last couple of weeks.
Yeah, I think there's a couple of things going on right now. I think the Fed has always tried to telegraph what they're doing. I think the Fed minutes that came out on Wednesday or Thursday last week, the one line or the one variable that Wall Street or smart money or whatever you want to call it missed or didn't catch, and maybe it's because the Fed wasn't saying it, was they're actually going to become sellers. I think everybody expected them to stop buying. Everybody expected a rate increase around March, April. What nobody was talking about, at least that I could find, was they're actually going to become sellers. And sellers of bonds is interesting because, of course, bonds and interest rates act inversely, right? They've been net buyers.
Well, so Powell's always wanted to reduce the Fed's balance sheet. So from day one, that's been his goal and his mission. He hasn't been able to do it. So people knew that was coming. The second thing, so I said the first thing is know to the top. The second thing I always say is watch what they do, not what they say. All right. So if you've been watching what the Fed and the insiders have been doing prior to the flag going up the flagpole, they've been selling. They're net sellers. So, and there's, a lot of stories out about Fed insider trading going on before these policy decisions. So you got to remember the members of the central banks around the world, Powell and all the rest of them, their money's in the markets just like everybody else. What do you think they're going to do? They're going to prop those markets up as long as they can until they can all get out. And when the Fed said no more trading from Fed board members, guess what? That was a signal. Top, get out. So they've been letting their buddies, themselves, their buddies, and members of the government around the world get out before they sent that flag up the flagpole. And now it's time to destroy everybody else. So watch what they do, not what they say.
That's great advice. One of the things that has been very apparent to me, like 20 years ago when I was very active in the market, is the retail investor came in. I think it's been historically pointed out, again, it's always history, but the retail trader is always late, right? They get in as they're like the last 10 or 20% of the market move, and then they stay too long and they get whacked, which I think is going on right now. If you were to kind of tell someone, again, this is complete guess, how long this great deleverage could take, to use a baseball analogy, do you think we're in the first inning, second inning? Where do you think we are?
Yeah, we're just getting started. Again, we're going to need to see markets taper about 20 to 30% across the board. And, how far and how fast that can go. Again, black swans, barring any black swans like we saw in March of 2020, that wasn't really a deleveraging. That was just a, black swan event.
That was shutting the economy down.
Yeah. I mean, the last example we saw of something like this was 2008 and 9. That took, a substantial amount of time. It seems like it was overnight, but it wasn't. That started, in 2008, maybe 2007, 2008, and it lasted through midway through 2009. So, I mean, this could be a 6-month process to get to the bottom of where we need to be. And, there'll be bounces along the way. We got a big red day right now that could, turn around and, reverse by the afternoon, as we've seen with the way the markets are right now. There's a lot of liquidity out there. The difference this time is you have a lot of the insiders are selling, especially in the NASDAQ. A lot of these tech companies that have just gone parabolic, they're all selling. A lot of insiders, like I said, in the Fed and the government and central banks around the world, they're all selling. So you got a lot of net sellers right now that you didn't have the last couple of rounds that we've seen a little bit of deleveraging here. So, it's going to take a few months and the Fed hasn't done anything yet. A lot's going to hinge on what Powell has to say this week when he speaks. I think tomorrow he's speaking.
Yeah, Fed speaks. Powell, actually, there are 7 Fed speakers this week. Fed president speaking. Powell is Tuesday. Yes.
Yeah. Okay.
And then we have CPI and PPI this week, right? CPI, I think expectations are 7%. I think they come in hot, maybe 7.1, 7.2. I'm actually calling 7.2. So. And again, a lot of this is because of the base effect, which people don't understand, right? The base effect really won't start being, right now, the base effect is negative, meaning it hurts CPI. The base effect will reverse. I think it's April of this year. But yeah, I think CPI is going to come in hot again. And Powell is, he trapped himself. He's got to do something.
Yeah. And this is all good. So this isn't doom and gloom. This is, where to understand we're headed. And, depending on what people's, investment strategy thesis is, you can play these little bumps, peaks and valleys on the way down until we get to the bottom again. And, what we do know is we know the Fed's going to step in. They're not going to let the market crash completely. They'll let it go down. We've seen them let it go down 60, 70%, definitely 50%. And that's the line where they're thinking about stepping in. We cross 50%, deleveraging, they're going to step back in again. Markets know that. Everybody knows that. So it's all a game now. And, all the way across the board. So this is an opportunity to understand where are we going? How far can it go? When do you get in? When do you get out? Crypto, is, having a down day right now across the board. And, I'm kind of waiting for an entry there, waiting for things to kind of settle out short term, because that market's a little bit different too. I think it still has a little bit more to go, before we see any kind of a long-term bottom, just like, financial markets. And we've got nothing but headwind right now. So there's no reason for an instant. I mean, we've just been hitting all-time highs, after each correction, but right now the Fed put is off the table. Yep. So all-time highs are done. So it's just downhill from here until the Fed's back in the game. Once they're back in the game, boom, then you can, start setting all-time highs again right now. So it'll be interesting to see if there's any recovery off of these down days. And that's your indication. If we don't get bought right back up, like has been happening, that's your indication that we're just on our way down for a while.
Yeah, Powell's speech is going to be interesting tomorrow because, again, the Fed meetings come out, meeting minutes. He gets roasted a lot, basically saying, hey, you told us like 4 weeks ago, just taper in rates. And now this suddenly you're selling. the market didn't like that. I'm sure it'll be interesting to see if Powell addresses that on Tuesday.
Oh yeah, yeah, because he's been 6 weeks ago. There's no inflation.
Yeah, exactly.
Yeah. So
Yeah.
I mean, like I said, they've lost all credibility. They're losing control of the ship to a degree with what they're doing, but a lot of it is calculated because they're protecting their own assets and that their friends and things like that. And I mean, that's not like corruption or conspiracy theory. It's reality. It's how it works.
Yeah.
They got to have time to exit quietly, before they can really, put the hammer down. The other headwind we have is rising interest rates. Bond yields are up again. Mortgage rates are rising, and I'm telling you, and this is on video, just like I said, the great deleveraging, 4% your number. If we hit 4% in residential, mortgage rates, that's going to significantly change the dynamics in the real estate market. And you're going to see, a big correction in the real estate market begin there. If you get up to 5%, it's just over.
Yeah, it's over. I'm actually just trying to check the bonds. Yeah, bonds. Yeah, 10 years, 1.79. I believe that's a 50 or not a 50. Oh, well, a 52-week high. Actually, it hit 1.8 earlier in the day. And then just because we talked
30 years over too.
Yeah, it's crazy. Yeah, is it? Let's see, the 30-year. Actually, I just have the 10-year on this slide. Okay. Yeah, 1.79. Yeah, this is great. Deleverage has started. It's early. Yeah, protect yourself. Right. There's clearly home builders, I know, saw this, but the construction ETF took a 9% whack last week because, again, rising rates make housing more expensive, all of these things. So again, the great deleverage is in force.
The direct correlation between interest rates and values, pricing of houses. And I'm telling you, they're directly correlated. And, for every 1% tick in interest rates, that's going to affect housing prices by 10%. Same thing in the commercial markets, cap rates and things like that. Because it's all about, in the commercial markets, it's all about income. You have to have a debt service ratio, appropriate to cover, to cover the debt. So as rates go up, it gets more expensive, prices go down.
Yeah. We're going to see. I think you and I disagree on one thing. I think 4% slows the market down, but it's transactions, not values. Yeah. If we get to 5% this year, which I can't fathom, we'd get that high that fast. But if we did, there'd be a big problem at 5%. Yeah. So
So just to clarify what I'm talking about 4%, that's when you will see the market drastically change. That's when you will see the correction begin, where you'll see inventory levels rise, days on markets go up.
We agree.
And you will see prices start to correct at that point, which they already are. In markets around the world, prices are already correcting now at 3%. Because rates were sub 3%. We're getting over 3 now. Yeah. Prices are already adjusting in a lot of areas. Buyers are pushing back. A lot of that is fatigue. But you start getting into the, mid to upper 3s, you'll see prices change. Okay. Just at that alone. And then once you get over 4, that's where it significantly changes behavior, kind of like what we're seeing now with inflation. Inflation is at a point to where it's changing consumer behavior now.
No, it totally is. And that's why I follow the consumer for almost 30 years. If you can figure out what the consumer is thinking, you really can play the chessboard. So that's why I've been following the consumer for so long. So Greg, this is always fun. Thank you for bringing us the great deleverage 6 weeks ago, maybe 8 weeks ago. We're going to talk about it because it's going to be happening for quite a while now. How can people find you?
GregDickerson.com. All my info's there. YouTube channel, podcast. Go check it out.
Thanks, buddy.